Welcome to today's video. My name is Madelon Vos and this is Madelon Talks. Today we'll discuss the most important macroeconomic and Bitcoin related news of the week, and in this week's video we have a lot to discuss. We're going to take a look at the CPI rates, the inflation rates, but we're also going to take a look at the fact that Treasury Secretary Janet Yellen of the United States of America said that the US might default on their debt in October if the government or the central bank doesn't step in. So this is something that's really important and we need to watch right now. But there's something else in China happening right now that we need to watch as well. That's the real estate development company, the biggest from China, who is on the verge of collapse. The company is called Evergrande, and this could be a shockwave going to the complete financial system worldwide. So this might be a black swan event. We're going to dive deeper into that. We need to dive deeper into that. But we're also going to take a look at Bitcoin because the price of Bitcoin went down over the last couple of days/weeks. And the question is, are we still following the like clockwork trend of plan B? So we're also going to take a look at the stock to flow model, and in the end we're taking a look at the chart of Bitcoin when doing technical analysis. But for now, I'm going to put myself in the right corner of this video, and I want to ask you that if you aren't subscribed to this channel yet, make sure to do so by clicking on the subscribe button down below. It's over here. And also make sure to click on the bell so you will get notified every time when there's a new video online. And I know that a lot of you guys, over 60%, haven't subscribed to this channel yet, so make sure to do so. And we're going to start this video with this tweet from Deutsche Bank, this quote from Deutsche Bank. And as you might know, we have been talking about the fact that inflation is here and that it's here to stay for over the last couple of 2.5 years, since December 2018 or so. And we've had the central bank saying over the last couple of months that after inflation was blowing up, that it's gonna be transitory. It will be transitory. That's what the Fed said. And at that time, I already said this is not going to be transitory if the government or the Federal Reserve, the central banks, don't do a thing. And they're still not doing anything. So this is going to be the fact. I'm one of the guys, one of the analysts, the economists that think that inflation is not going to be transitory. And this is because I've studied monetary economics for years and years and years and years. And right now, there are a lot of analysts who think the same, but we're still quite a small group. If we take a look at Deutsche Bank's quote, they said, assumptions that inflation is temporary are reducing, but still the most popular perspective. So there's still a large group of people who think that inflation is temporary or transitory, as the Fed calls it, but the group is becoming smaller and smaller. And I think that's for a reason. People start to realize that if they don't do anything, inflation is going to hit the fan. Shit is going to hit the fan. I'm going to explain you why. Because we've just had the inflation data and it turned out to be lower than expected. The CPI year on year went to 5.3% and the core went to 4.0, but 0.2% lower than expected. And why is this so important? If you take a look at the inflation basket, then you might know that there are some products and services and goods that are together in this basket, but there are some that are excluded in this basket. For example, the rent inflation. And if we take a look at, this is what the core CPI and the CPI did. And if we take a look at this rent inflation, then we see that these rents are increasing quite fast. And if we combine them together, the US national rents compared to the CPI rate, then we're seeing this result. So this means that the actual decrease of your purchasing power is way higher than that these figures show you. And keep in mind that if the value of your money is decreasing more than 5% a year, that in a decade or so, your money is almost worthless. So keep that in mind. Your purchasing power is decreasing way faster than these figures show you. And this is where it becomes really interesting, because if we take a look at the CPI report over last year, so this is year on year, August, then we take a look at the prices of gasoline, used cars. Gasoline is up 42.7%. Used cars are up 31.9%. The overall CPI is only 5.3%, but if we take a look at the home food at home or gas, utilities, new cars, they've increased in price quite bad. So keep this in mind when looking at this overall CPI. It depends on what you put in the basket and how you measure the weight of every product, good, service in this basket. But there's something important that I wanted to share, because I've been tweeting about the wage push inflation quite often, and I feel like people don't get what I wanted to say. And I'm going to explain this with this tweet from Tavi Costa, our favorite analyst, and he is tweeting about the fact that McDonald's is now paying $18 an hour, and that's quite a lot. And why is this so important? Because in the comment section of this tweet, a lot of people said, oh, I'm going to work at McDonald's because they pay a lot. Oh, it's quite nice. This is not quite nice, because this means that we are going to see a systemic risk evolving when it comes to inflation and rising prices. So a lot of people are now sitting at home because the prices in the restaurants, the wages in the restaurants, I mean the wages for having a job at a restaurant, having a job at a supermarket, are way too low. So they rather stay home because money is almost free. And this means that things are expensive. Rent is expensive. Buying a house is quite cheap compared to the rent, for example. And this means that a lot of people rather stay home, and that there are more jobs available than there are people who are willing to have that job. So there are a lot of job openings. In the US, it was 10 million, and I think it were only 9 million people that are willing to have a new job. So this means that they have a deficit of 1 million people. And this is where it becomes quite interesting, because McDonald's is willing to have more employees. And this means that these employees are going to have more money available. And then you will have the systemic risk, because you get this vicious cycle upwards. And this vicious cycle is quite bad, because right now the prices are quite high and people are saying, I want to have a higher wage because otherwise I can't pay my rent, I can't pay the supermarket, I can't get food or something like that. So what we're going to see are higher wages. And this means that these people have more money to go to the supermarket, go to a restaurant, or pay a higher rent. And this means that the prices are going to increase. And then you will have new employees who are going to say, I want a higher wage. So you will get this vicious circle, this vicious cycle of higher wages, higher inflation, higher wages, higher inflation. But of course, these wages are not increasing as fast as inflation does. So in the end, you as an employee will find out that your purchasing power is still decreasing, because you are not going to get an increase in salary of 5.3%. That's not going to happen. Maybe it's going to be 2.5%, and you're still going to have 2.5% more to spend, but it's not enough to manage the effects of inflation. But this is still where it's going to be messy, and where we have this vicious upward cycle of increasing prices, and that's why it's not going to be transitory. And there's something else why it's not going to be transitory, and that's, for example, the producer prices. And I'm going to explain this with this chart from Shanghai. This is what a container from Shanghai to Los Angeles costs. For example, in in the middle of 2020, the price of a container full of shoes, for example, from China to Los Angeles was around $2,000. Right now, this price is sitting at 11.3 thousand $. So that's quite an increase. And this means that we have to take this to account in the final product, in the end product. For example, in the shoes. If we are going to send shoes from Shanghai to Los Angeles, they have an increase in price because, for example, take a look at this. Gasoline is more expensive. Gas utilities is more expensive. Electricity is more expensive. And these shoes need to be made. And they need to be transferred to the other side of the ocean. So that means that we have the wage push inflation coming from higher salary, but we also have an inflation on the producer price index side of this story. This will be included into the price of the finished product and thus result in more expensive products and smaller margins for producers. And the producers will have smaller margin because they can't also higher the prices as fast as the producer prices are increasing. So they can't higher prices 8.3% because then people won't buy it anymore. So they are probably going to increase it with 5% or so. But still, we're going to see smaller margins for producers, higher prices, smaller real wages for employees. They're going to have problems with buying products and keeping their purchasing power, remaining their purchasing power. So this is heavy. And Pomp is saying the following: the most vulnerable in society are being crushed by rising costs, while asset owners get rich. Don't complain about it, start investing. And I wanted to show you a video of Pomp speaking about this complete story that I just told you about, and also about the fact why this is so important to keep in mind.
Bitcoiners understand the US economy better than Wall Street. I've been saying this literally for over a year now. This was so obvious. Go back, check the receipts. Last year, inflation's not going to happen. Don't worry about it. We have no concerns. Bitcoiners were up in arms, yelling and screaming about it. Then it became this story of it's transitory. We are now talking about compounding inflation annually of 4 to 5% for half a decade. You will not survive financially if you simply work an hourly job and save dollars. Get out of your hourly job because they're not going to go ahead and increase your pay enough to keep up with it. They're going to pay you less and less and less year after year after year for the coming years. And two is, if you're a saver, you're screwed. You have to learn to invest. I don't care what assets you invest in. I don't care if you like equities, real estate, commodities, crypto, whatever.
So he's actually almost saying the same thing as I am. But the only difference is that he's saying that as an employee, you have to cut your job or your wages aren't going to increase. I think that we are going to see wage push inflation, but this is not going to keep up with inflation. So I completely agree that people should start investing because there's no other option to remain your purchasing power. And he's talking about the fact that this CPI is going to be here for years over years over years. He's speaking about half a decade. And this means that you can do a compound effect on the decrease in purchasing power. You've probably heard about compounding interest. When you are putting money in the stock market, you have a compound interest because you first put $100 in and then you will have 7% over $100 and then you will have 7% over $107. And this is what you're going to see, but the other way around. Same for negative interest rates. You are going to have a big problem if you don't do something with your money right now because your purchasing power is going to decrease way faster than expected. Okay, that was my complete thesis about the fact that inflation is here to stay and that we need to do something. And right now we have something else to discuss because The US could default on its debt sometime in October if Congress doesn't take action to raise or suspend the debt limit. Treasury Secretary Janet Yellen warned on Tuesday. So what's actually going on is that the US, of course, is bankrupt already, but they're having a debt risk. So a debt limit, for example. So what's going on right here? As you might know, the government has a budget every year, and if they have to pay more money for several things that they want to achieve, then they have a deficit. So this means that they have to issue more government debt, and the central bank will then buy the debt so that the government can do investments in the economy or in society or something like that. But right now they have a limit of debts that they can issue. And what's going on then is that they can't pay their debts anymore, and they're going to be bankrupt if they don't do anything. But they can simply higher the debt limit, and then this problem is completely solved. But this means that they're going to default. They're defaulting already if they didn't have a debt limit. It's completely the other way around, because if you have a home and you have a salary and you can't pay your normal lifestyle with your salary, then you have to cut your lifestyle. You have to cut something from your lifestyle. But the government doesn't do it that way. They issue more debt, and you could get a loan, for example, but then the bank will say, okay, now it's done, you can't get more loans. But then you're going to the bank and says, please, I'm going to get bankrupt, can I get a new loan? And that's what the US is doing right now. So it's nuts what they're doing, but that's what's happening. And then there is this really important news about Evergrande. Evergrande is the biggest real estate developer in China, and they're having liquidity problems right now. Home buyers, investors, employees are laying in front of the door of this company, and they're demanding a repayment of their loans and their financial products. For example, if home buyers wanted to buy a house, they had to pay Evergrande up front. And right now Evergrande has liquidity problems, so they can't buy the house. But they can also do a repayment on the loans or on the debt that they have to pay off. So this is a very big thing right now, and this could be a black swan event. And you're probably thinking, what has China to do with a black swan event like Lehman Brothers in 2008? Evergrande has 200 billion in assets and 300 billion in debt, and this is a total of 500 billion. Lehman Brothers had a total of 500 billion in debt right before it collapsed, and it had a shockwave all around the world. And these loans could cause a shockwave all around the world as well, because these loans are on the balance sheets of banks in the UK, in Europe, in Australia, in the US, in Canada. And this does not only form a financial risk or systemic risk to the financial system in China and the housing market, but this could form a risk worldwide. And the only question right now is, will the government bail them out? If the government bails this company out, then it's going to be a nationalized company, and it will end up okay. But what Evergrande is doing right now, they're trying to sell the houses, the real estate that they own right now. And this has a decreasing pressure on the housing market. And what we see right now is that not only the stock price of this company, which decreased, I think it was 49% in 1 month, not only this company stock price is decreasing, but also from all the other real estate developments, developers in China, but this could lead to a whole collapse of the housing market. And this is not going to be a collapse in one day or 1 week or one whatever. This is going to take months. It's not a question if this company needs a bailout or is going to get bankrupt. It's a question when and how big the collapse will be. And I hope that the Chinese government will step in so that there won't be a lot of problems and that we can just do our thing. But we're going to keep this in mind, and this is going to be the story of the week for the next coming months or so. Okay, Gold Telegraph also said an Evergrande collapse has systemic consequences. Bondholders will get completely destroyed. And think for a second, the company is the largest issuer of US dollar dominated Chinese junk bonds. Evergrande debt is 2% of China's GDP. This will spread all over the world, in my honest opinion. And I completely agree with this. So this story is not over. Prominent US real estate firm to accept Bitcoin for its New York City properties. This is quite interesting because at the time that the Chinese housing market is under pressure, we see the housing market in New York City moving towards Bitcoin. Quite interesting. So they're selling properties for Bitcoin. I would never sell my Bitcoin for a house, but maybe some people would do it. It's obviously a good marketing stunt. And in the meantime, the Bank of International Settlements, Innovation Hub Benoit Coureux, asks central banks to urgently develop central bank digital currency to compete with crypto assets. And this is quite an interesting quote because he said, "Today the financial system is shifting under our feet. Central bank digital currencies will be a part of the answer." And then he said, "The time has passed for central bank to get going. We should roll up our sleeves and accelerate our work on the nitty-gritty of the central bank digital currency design. CBDCs will take years to be rolled out, while stablecoins and crypto assets are already here. This makes it even more urgent." So they're seeing that this whole financial system is going down the drain, and at the same time people moving towards Bitcoin as a means of exchange, as a payment mechanism, and as a store of value as well. So Bitcoin is everything that is good in financial phase as we are in right now, and they're seeing this. That's why they want to roll out this central bank digital currency, and they need to, because their financial monetary system is coming to an end. And when looking at Bitcoin, we've had this tweet of Plan B, and this is where it becomes really interesting. He had the worst case scenario for 2021 based on the price and on-chain data, and he said August will be 47, September will be 43. We already hit 43 in September. October will be 63. November will be 98, and then it's going to get fast upward to 135 or so, maybe even through January, going up higher as well. So this is where it becomes more and more interesting, because if we take a look at the Bitcoin chart, and we're going to do that in 1 minute. If we take a look at the Bitcoin chart, then we are seeing some disturbing things. I hope that Plan B, of course, is right, but this is hopium. But if we take a look at the macro perspective, take a look at the whole financial situation, then there is need to get more Bitcoin. There is an urge to get more Bitcoin if we take a look at what the devaluation of the dollar is doing right now. And I can imagine that this is going to be an upward trend from here now. But we have technical analysis as well, and I want to show you something. And then we're going to take a look at the chart of Bitcoin. We're currently looking at the daily candles, Heikin-Ashi candles on the Bitstamp chart. And what is interesting about this is that we see that history rhythms. It's not repeating itself, it rhythms. And as you see, we're seeing something that's really interesting, and that's called fractal analysis. And fractal analysis is when cycles are looking almost the same. And as you can see here, we had an upward movement, then we had a downward movement, an upward movement, and a downward movement. Here we had this upward movement, a downward movement, an upward movement, and a downward movement again. Then we had a temporarily all-time high. We had an all-time high over here. Then we moved up to a new top. We moved up to a new top over here, after declining, of course. And after that, we saw decline. After that, we saw decline. Now is the time to move upward and then downward again. So now is the time to move upward, lower than this high. So it's going to be lower than 50K. And then we might see a downward movement again, if it goes as following. So we had here this head and shoulder pattern. We broke out downward, and we might see a new head and shoulder pattern evolving as well over here. And that means that we could see a low until this level. So we have had this first upward movement, and we went as low as this, almost as low as the wick of this candle. And that means that we could go as low as 37. And I'm going to show you this chart with my drawings. So we had this head and shoulder pattern. This was exactly the target point of this head and shoulder pattern. But right now, we could go to this area. And this is 37. And that's not really what we want to see, right? And not what Plan B predicted. And this makes me think that if this is going to happen, what is the stock to flow worth then if we're going to see a new low like this? And afterwards, the question is, what are we going to see then? Are we going to have another movement upward, but way lower than we have seen? And this is a movement. It doesn't look like a top formation, because usually when the market is stopping, it's going super fast. It's going upwards super fast, and then it's going to spike down real quick, as we saw here. But this is not, I don't know, it's still too strong in my opinion, besides the fact that the volume is decreasing heavily. Volume is decreasing. We've had some bearish divergence, which we broke down right below this level, and then we had to sell on this area. But if we take a look at the 4-hour charts, this could be a head and shoulder pattern, or this could be a head and shoulder pattern if we draw it the same way as we did in the other pattern over there. But if we go upward again, and we're going to see a higher high than 50K, this is going to be the best news ever, because that means that we're going to go way higher than we've seen before. So we want to have a higher high than 50.5. Let's say it's going to be 50.5. But if we fall below 44.7, then we have a big problem. Let's keep in mind this one, 34.4. If we break below 34.4, then the show might be over. We might go down to 37.5 again. Let's hope we won't. I can see a lot of patterns right now. This is completely based on fractal analysis, which in a lot of times doesn't make a lot of sense. But right now it's so obvious that it's almost looking the same. But let's hope for a higher high than 50.5 right now. But it's going to be interesting. I wanted to tell you, by the way, that we have support links available. I put it over here, and I will put it upward as well in the information button. And if you use these support links, then you will get a discount on trading or get free Bitcoin or something like that. So take a look, make sure to take a look and see what platforms I like to use, because I get a lot of questions about that. That's why we made the support links, and we managed to arrange a special deal for you. So make sure to take a look at the information button or go to the link down below this video. For now, I would like to thank you for watching this video. I would like to remember you that I'm on Twitter as well. And also make sure to follow me on Twitter, because I'm posting all day about financial markets, about macroeconomics, and about Bitcoin. and you will be up to date during the whole day. And don't forget to press the thumb if you like this video, and I hope to see you soon next week. Also make sure to put something in the description to let me know what you think of this video, and if you have any suggestions, also make sure to put them down below. For now, I'd like to thank you and see you next week at new Madelon Talks. Bye!